Hello and welcome to our discussion on bonds. In this vignette, we will discuss issuing debt as well as the accounting for bonds. Firms can raise capital by issuing debt securities, commonly known as a bond. A bond is an agreement where the borrower, the firm, receives a lump sum of cash, the principal, in an agreement to make periodic payments, the interest payments, and return the principal back at a later date, the maturity date. The stated amount of payments the bond will make, as well as the nature of the issuance, will have an impact on the accounting for bonds. We will first focus on the terminology and then go through some examples together. Why might a firm issue a bond? Firms may want to issue a bond to raise capital to fund long-term projects or as a way to meet their short-term cash needs of operating activities. Bank loans, while useful, generally do not provide enough capital to cover those firm needs. So many firms borrow money from the credit markets using a bond. Bonds provide a clear payment structure as well as a high-quality source of capital that firms routinely use. Let's quickly discuss some of the properties of a bond. The face amount, or the principal amount, is the amount of money that is borrowed that is to be returned at maturity. The interest payment, sometimes called the coupon payment, is the agreed upon cash paid over the period of the bond being borrowed. The payment period is how often bondholders expect to be paid their interest payments. The length of borrowing describes when the bond will mature and when the principal amount will get paid back to the bondholders. When firms initially issue a bond, they may issue it at a par, premium, or discount. Whether they issue at a par, premium, or discount will depend on the firm's intended coupon payment versus what the market expects to receive in return for loaning them money. As users of the financials, we will not focus on how the interest rate is set, but it's going to be important for us to know that sometimes the market rate differs from the coupon rate, and it will have an impact on how we account for the bond. Along this line, let's quickly discuss the coupon rate versus the market rate. The coupon rate is the stated rate in the bond contract, and it is used to compute the interest paid to bondholders. Other terms for it are contract rate or stated rate. The market rate is the rate that investors expect to earn loaning the money out to the firm. This is used to price the bond at issuance, and it is also known as the effective rate or the yield rate. When a firm closely matches the coupon rate to the market rate, i.e. when the market rate is equal to the coupon rate, we say that the firm has issued the bond at par. When the firm issues a bond with a coupon rate that is lower than the market rate, we say that the firm has issued a discount bond. In the third category, when the market rate is lower than the coupon rate, meaning our coupon rate exceeds what the market expects for borrowing this money, we call this a premium bond. Let's take an example and see how these three types of issuances work. Suppose we have a firm that pays semi-annually and will borrow $400,000 over 5 years. In a situation where we issue the bond at par, this $400,000 bond with a coupon rate of 8% will have also a market rate at 8% and will receive at issuance $400,000. That is, the firm will issue the bond equal to its face value. If instead the market rate exceeds the coupon rate, i.e. the market rate is 10% and the coupon rate is 8%, we will issue these $400,000 bonds at a discount. We will receive only $369,113, i.e. less than the face value. We've calculated this using a present value of discounted cash flows, which we will not cover in this vignette. If we were to sell the $400,000 bonds with a coupon rate of 8%, but the market was only expecting 6%, we would have issued this bond at a premium and received more for the bond than we expected. i.e., we would have gotten $434,121 from the market at time of issuance, an amount that is greater than the face value of the bond. Continuing with this example, let's see how the accounting would work out for the par, discount, and premium issuances of the bond. Again, suppose that Firm A issues the previously discussed 5-year, $400,000 face value semi-annual bond with a 8% coupon rate issued at par. Using our assets equal liabilities plus equity balance sheet equation, we first record that the bond payable will be $400,000. This is the amount that we are going to owe bondholders, and it equals the face amount of the bond because we issued it at par. Additionally, we got $400,000 in cash, and we bring that up in our assets side of the balance sheet equation. This is the amount that we actually received from the bond market, which equals a face value. Notice there is no income statement impact yet because we have just started borrowing the bond. Let's take the situation where we instead issued the bond at discount. That is, the market rate was 10% and we issued it paying 8% per period. With our balance sheet equation, we'll record our bonds payable in the amount of money that we actually borrowed, not the face value. When we issued it at a discount, we were able to borrow $369,113. And again, this is the amount that we are going to bring in from the market by issuing this $400,000 discount bond. We will also record the cash balance, and this is because this is how much we got from the market issuing at a discount. You'll notice that the amount that we received from the bond market is lower than what our face value is because our coupon rate is low compared to the expected market rate. Again, no income statement impact. However, we should separately keep track of this discount. The discount is the amount of difference between what we issued the bond at face value, $400,000, and what we actually got from the market, $369,113. If instead we issued it at a premium where the market rate is 6%, we must record the full amount that we got paid for that $400,000 bond. That is, our liability will be for the full amount of $434,121. We are going to owe that money back. However, we will owe the face value back, and we will see that as we record the bond over time. We also record the cash, $434,121, because that is what we got from the market. And again, we have no income statement impact. We also here would keep track of the premium. The premium is the difference between what we actually got from the market and the face value of the bond, $34,121. So, we're reviewing what we just did. When we issue the bond at par, we have on our balance sheet a bond payable that is equal to the face value, $400,000. When we issue the bond at a discount, we take the face value and remove from it the discount that was incurred because we didn't have a competitive rate compared to the market. We then record our liability under a discount issued bond of $369,113. For the situation where we issued the bond at a premium, we take the face value of $400,000 and add to it the premium because we also got that from the market. Our bond payable net will be $434,121. The bond discount reduces the net liability, whereas the bond premium increases the net liability, and we will account for that over the life of the bond up until maturity. Pause here. If you are not comfortable with the material thus far, please go back and review. If you are, please continue. Let's continue. In the second half of the vignette, we will discuss the accounting for payments associated with the bond. Remember, the firm is contractually obligated to repay the bond's coupon payment to bondholders. The cash that we pay each period is going to be fixed based off the coupon rate. However, the economic cost of borrowing is going to be accounted for under accrual accounting. US GAAP requires us to use something called the effective interest method when determining the income statement impact. This is going to be important, especially for bonds that are issued at a premium or a discount, because we need to make sure we amortize that discount or premium. Let's take the simple situation where we have a coupon payment for a par bond. Thinking back to our example, we had a bond that we issued at par where the coupon rate was equal to the market rate, 8%. For the interest expense on the right-hand side of the equation, notice that the economic cost of borrowing is going to be the market rate divided by 2 times the payable. This is going to be 8% divided by 2 times 400,000, which will result in an interest expense of 16,000. On the asset side, we will calculate the cash paid slightly differently. It'll be the coupon rate stated in the bond divided by 2 times the face value of the bonds. This also is 8% divided by 2 times 400,000. Notice here that the cash paid is equal to the interest expense. That is because we had the bond issued at par. The income statement will record an expense for interest expense of 16,000. In the case of a discount or premium bond, we must consider the amortization of that discount or premium. This is going to be recorded on the income statement by adjusting the effective cost in the interest expense. In the situation where we had a discount, notice that we will have to take our cash interest paid and add to it the amortized discount to arrive at our interest expense. For the situation where we issued the bond at a premium, the cash interest paid will be reduced by the amortization of that premium to arrive at interest expense. For the discount bond, notice that this is an additional cost to the issuer, whereas for the premium bond, this is a benefit to the issuer, reducing the interest expense. Let's first focus on the discount bond and take a look at the amortization schedule. Remember, in our example prior to the pause, we had a discount balance for our discount issued bond of $30,887, as well as a net bond payable of $369,113. The market rate of interest that's being used to calculate interest expense, you'll notice is 5% because we are in a semi-annual bond. 10% divided by 2 is our 5%. Similarly, our cash interest paid will be based off a rate of 4% because we will take our coupon rate of 8% and similarly divide it by 2. To calculate our interest expense, we must take the opening balance of our bond payable and multiply it by the market rate at time of issuance. This is $369,113 times 5%. We arrive at an interest expense for this discount bond of $18,456. Notice our cash paid throughout the life of the bond is equivalent per period, $16,000. That is because we calculate cash paid to bondholders as the face value, $400,000, times the coupon rate, 8%, divided by 2 since we're doing semi-annual payments. The difference between the interest expense and the cash paid is the discount that is amortized. This will reduce our discount balance and have us arrive at a lower discounted amount. Because we have reduced our discount, we must increase our bond payable correspondingly by the amount of discount that is amortized. Let us zoom in on this first payment and do the accounting for it. However, I want you to first take a look down at semi-annual period 10. You'll notice that even though we have a discount bond, our total bond payable net will equal our face value by the end of the period, by the end of the maturity period. We will have an outstanding balance of $400,000 in period 10, which is equal to the face value for this discount bond. However, we must amortize this discount over the life of the bond until we get there. Again, let's zoom in on the first transaction. For a coupon payment on a discount bond, let's take a look at what our previous example showed us. Notice here that our cash payment is the same. Cash is always going to go down for the coupon rate multiplied by the face value. Here we have 8% divided by 2 times 400,000 to get a cash payment of 16,000. We will increase our liabilities by the discount that is amortized. We will be able to identify that by calculating the interest expense, which is the economic cost of borrowing, as the market rate divided by 2 times the opening payable. That is 10% divided by 2 multiplied by 369,113. The difference between the interest expense and the cash paid will be our discount that is amortized. Our remaining discount is 28,431. Switching to the premium bond, here's the amortization schedule for that. Again, our interest expense will be calculated using 3% because, remember, our effective rate of interest at time of issuance for our premium bond was 6%. 6% divided by 2 is 3%. For our cash interest paid, again, we are going to use our coupon rate divided by 2. 8% divided by 2 is 4%. Notice here that we have a much smaller interest expense because we are using our market rate of interest times our beginning balance of bonds payable. That is 434,121 times 3%. We will have our cash interest paid that is the same, 16,000, which is the result of 400,000 in face value bonds times 4%. The premium that is amortized is simply the difference between the cash paid and the interest expense. This will reduce our premium balance, which will similarly reduce our total bond payable net over the life of the bond. Again, looking at period 10, you can see that our bond issued at a premium will eventually arrive down to the face value of 400,000, similar to how the discount bond was as well. Let's zoom in on the first semi-annual payment to record the accounting transaction. For this bond that was issued at a premium, notice again that the cash that we paid is equivalent to the discount in the par situations. Cash paid is going to be 8% divided by 2 times the face value of 400,000, $16,000. The economic cost of borrowing here, again, is going to be our interest expense, which is calculated as the market rate divided by 2 times the opening balance of the payable. For this situation, we had a 6% effective market rate at time of issuance divided by 2 times the opening balance of the payable, 434,121. This gives us an interest expense of $13,024. The difference between the interest expense and the cash paid is going to reduce our total bonds payable by the amortized premium. Notice on the income statement, we record the interest expense of $13,024. Our remaining premium here is $31,145. Bonds that are traded in the secondary market between bond holders will be traded at market value. The market value is going to affect the price of the bond, and that will fluctuate over time based on the market conditions as well as the prevailing interest rates at that time. From the standpoint of the company, however, these market changes are not recorded in the financial statements. However, they will provide a footnote disclosure that will contain this information. If the firm wanted to retire or get rid of that loan, what they can do is go out into the open market and repurchase their own bonds prior to maturity. They will do this through open market purchases and must purchase the bonds at the fair value that they are at of that day. When they are repurchased, a gain or loss may result because the firm is going to have to pay the prevailing market rates. Gains or losses will be recorded as a part of income, similar to how we record a gain or loss for PP&E. That concludes our discussion of bonds in this vignette.